Imagine you are in the future in 2021 and you read the news headline Sensex has completely recovered from the coronavirus stock market crash. Yet your portfolio has not recovered. How would you feel then? If you could go back in time and change anything, wouldn't you do it? Recover your portfolio better and faster from the coronavirus stock market crash. This is the part 3 video of this series of videos presented by Holistic Investment Planners. I would like to start this video with a simple question. Are you in a SAP dilemma? The stock market underwent a big crash because of the coronavirus outbreak. Your portfolio has seen a big loss already and the market is still uncertain, still highly volatile. At this point, continuing your SIP may not make sense at all. So what can you do? Should you quit your SIP or should you continue your SIP? I am seeing people asking questions like, what should I do with my SIP at this point, right now through this crisis? To all such questions, I have only one answer. Play smart with your SIP. Playing smart with your SIP. As an investor, as an SIP investor, you have only 3 different choices. Either you can stop your SIP, or you can continue your SIPs, or you can increase your SIPs. One of these choices is the smartest way to go. But which one it is? Let's find out with a little experiment. So it's experimentation time. SIP Smart Experiment 1. Let's assume 3 investors, Mr. A, Mr. B and Mr. C. Each of them investing Rs 10,000 SIP in a mutual fund scheme. They are investing from 1999 to 2004. It is in this period the dot-com crisis happened for 18 months. During the market fall for 18 months, Mr. A chooses to continue his SIP, whereas Mr. B chooses to stop his SIP for 18 months throughout the market fall. And Mr. C chooses to increase his SIP to 15,000 for the 18 months period. So, what do you think would have happened at the end of their SIP investment by the year 2004? The result is on your screen. As you can see, each of these investors have earned 3 different profits by the end because of their 3 different approach towards the market fall. Mr. A, who chose to continue his SIP, earned almost 18 lakhs by the end. And Mr. B, who panicked and stopped his SIP, has earned only almost 13 lakhs. But Mr. C, who increased his SIP throughout the market fall, earned more than 20 lakhs. This is a big difference. Let's see the insights from the analysis. First, increasing your SIP gives you the highest profit, especially increasing it during the market fall. And continuing your SIP during the market fall gives you a moderate return. It is not the best choice, but it does the job. And third, stopping your SIP gives you the lowest return of these 3 options. It is not the best way. So, choose to increase your SIP during this coronavirus market fall. It is the smartest way to go. But let's not jump to conclusions now. Let's increase the sample size by doing another little experiment. SIP Smart Experiment 2. Let's assume 3 investors, Mr. A, Mr. B and Mr. C. Each of them investing Rs 10,000 SIP in a mutual fund scheme. They are investing from 2007 to 2012. It is in this period the global financial crisis happened. The crisis happened for 15 months and during the market fall for this 15 months, Mr. A chooses to continue his SIP, Mr. B chooses to stop his SIP because of his panic reaction for the entire 15 months market fall, and Mr. C chooses to increase his SIP to 15,000 throughout the market fall for 15 months. So what do you think would have happened? At the end of their SIP investment, by the year 2012, this is the result. As you can see, each of these investors have 3 different profits by the end because of their 3 different approach towards the market fall. Mr. A, who chose to continue his SIP, earned almost 11 lakhs. And Mr. B, who stopped his SIP because of the panic reaction, earned almost 8 lakhs. But Mr. C, who increased his SIP throughout the market fall, earned almost 13 lakhs. As you can see, the difference is very evident that Mr. C has the right approach towards a market fall and is the smartest person among these three investors. This is a striking similarity between these two experiments, isn't it? Increasing your SIP gives you the highest return. Continuing your SIP gives you the moderate return, which is not bad. But if you choose to stop your SIP, you will only get poorest returns and it could hamper your portfolio recovery. So, here are the key learnings to become SIP smart. First, regardless of market volatility, remain invested, continue your SIPs. Second, tie your SIPs to a financial goal. It helps you keep investing. Without a financial goal, you are just firing arrows in the dark. Third, a year is a very short period to judge equity market. Give your SIPs at least 5 to 7 years to grow and mature and give you the profits. And finally, increase your SIPs during a market crash for faster portfolio recovery. So, what do you think? Are you ready to become SIP smart or are you still confused? If you are still confused, how do you feel about a professional's assistance for your faster portfolio recovery? Reach out to us, Holistic Investment Planners, anytime. We provide free 30-minute consultation. Register for yours now. You can find the registration link in the description below. If you like this video, like and share this video with your friends. And be sure to subscribe to Holistic Investment Planners.